Hi, everyone, and welcome to our PSAS update on the impact of COVID-19. For those of you who attended our session last week, our IFRS update, welcome back. For those of you who are joining us for the first time, hopefully you find today enjoyable and informative. My name is Armin Capisciolto. I'm BDO's National Accounting Standards Partner. And it looks like most of you today have joined using the WebEx platform. Let's say if you just move to the next slide. For those of you who haven't joined using the WebEx platform and want to send questions, you can by emailing me. My email was in the email with the login information you received. But in case you didn't note it, I'm going to spell it really quickly. It's a long one, so I apologize for that. It is ACAPISCIOLTO@bdo.ca. So you can send any questions you have if you're not on the WebEx platform to me at that email address. And we'll have a question and answer period at the end, and we'll try to get as many questions answered as possible. For those of you who have logged into the WebEx platform, if you have any questions, please send them through the Q&A feature and send them to all panelists. We're obviously not in the same location, therefore so we can all see them. As far as who will be doing the majority of the presenting today, I am joined by Alicia Croskery. She is a partner and a group technical leader for our Eastern Canada group. Alicia has an abundance of experience in the public sector with municipalities, Indigenous governments, and other government not-for-profits and other government organizations. Saya Barton is a director in our National A&A team, and Saya concentrates in the public sector and is actually currently a member of the PSAB the Public Sector Accounting Discussion Group. So they will be doing the majority of the speaking today. So what are we going to be covering today? Well, we're going to again be focused on March 31st year ends. Obviously, those are the year ends that are most critical in the public sector, as most entities have March 31st year ends. But we will touch upon some of the issues that go beyond March 31st, 2020, and things that you're going to have to think about, for the foreseeable future related to COVID-19. The biggest difference from this session versus the IFRS session is a lot more focus on audit. For those of you that did attend the IFRS session, this slide will look familiar. I think it goes without saying the issues are complex, and as we get into the audit issues, I think in some ways the audit issues are even more complex than the accounting issues. What I will say is, from a public sector accounting standards side, the issues are maybe less pervasive than they are on the IFRS side, and that just might be the nature of the standards and less estimates existing in PSAB versus IFRS, especially for March 31st. But the issues are still complex, and what we're focusing on here is just like identifying the issues, and really it's all going to be facts and circumstances based solutions for your individual situations. The one thing before I turn it over to Alicia and Saya that I really want to comment on, and especially, and I think this is really critical from an audit standpoint, and we're all auditors on the line here, is the importance of supervision and review. And we're really in unprecedented times, and that experience that the more senior members of a team bring to the audit is absolutely critical in these uncertain times. And I'm assuming no one on the line was auditing financial statements or governments at the time of the Spanish flu. But that experience, although we don't have experience with this, the experience you've accumulated throughout your career is really going to be important in helping teams get through these challenging audits. And there's various factors you have to consider, and Alicia will comment more on some of these later on. But the one thing I really wanted to point out, I think is absolutely critical in these times, is understanding the stress of the team members. Your audit team members understand the stress that the entities you're auditing are facing. The challenges of working from home, the challenges of just everything going on in society related to this are all things that, indirectly impact what we do as auditors. And I just want to highlight that before we get into the details. So with that, I will stop talking and turn it over to Saya, who will walk you through some of the March 31st, 2020 issues.
Thanks, Armand. So like Armand said, we're going to focus now on some of the key considerations and things to keep in mind for March 31st, 2020 year ends. So the World Health Organization did not declare the COVID-19 outbreak to be a public health emergency until January 30th, 2020. So if you had an entity that had a December 31st, 2019 year end, the economic and business impacts that are resulting from COVID really weren't in existence at year end. So for those entities, these would be subsequent events for them, and those subsequent events would most likely require disclosure given the nature of the impacts from this virus. Now, when we're dealing with March 31st year ends, the WHO had declared the COVID-19 outbreak to be a global pandemic on March 13th, 2020. So the business and economic impacts were already in existence at March 31st. So it's not just a subsequent event for us. So in this situation, we're going to need to have recognition and measurement adjustments for a number of items at March 31st. And we're going to talk about some of those during the WebEx today. But there are still actions that were being taken around that year-end date and after that year-end date to slow the spread of this virus and to slow the spread of the economic consequences and try to combat some of those that were happening subsequent to year-end, and the outcome of those actions may become known in a subsequent event period. So it is still possible for March 31st year-end to have subsequent events related to COVID. So we really need to look at, are those events that happened after year-end, are they just confirming conditions that existed at year-end, and as a result, they are going to require recognition and measurement, or are they new things that happen after year-end that are subsequent events that are going to potentially require disclosure depending on the impact they have on the financial statements? So that's just something to keep in mind there. The other thing is, as a result of the impacts of COVID and the shutdowns, a lot of your audits are being delayed. There's a delay in some of the public accounts that are going to be issued. So we're going to have longer subsequent event periods than we normally would in some situations. And the longer a subsequent event period is, the more specific that subsequent event disclosure should be because more information is known. Now, in your government financial statements, obviously you need to balance that with the level of detail that you need to provide. But there is likely going to be quite extensive subsequent event disclosure needed this year. And you really just need to tell the story of how COVID is impacting your entities. So if we move on to the next slide on going concern, and for those of you who may not be attending using the WebEx platform and who are just following along with slides on your computer, we're now on slide 9. So under PSAS, financial statements are prepared on the assumption that a public sector entity is a going concern, which means that it's going to continue operating, it's going to be able to realize its assets, discharge its liabilities, and meet its obligations in the normal course of operations for the foreseeable future. And most governments are long-term institutions, so under normal circumstances, they're expected to operate in perpetuity, and we don't usually worry too much about going concern for such entities. Instead, we focus more on going concern assumptions related to the individual government organizations, so government not-for-profits, other government organizations, GBEs. But this slide here really illustrates the unprecedented nature of COVID-19, and it shows a couple of recent articles on how COVID is impacting municipalities. So municipalities are facing increased costs as a result of the outbreak. They're facing decreased fees and deferred or uncollectible property taxes. And depending on how much the impacts from the outbreak actually impact their financial situation, it may call into question whether some municipalities are actually going concerns and whether going concern disclosure is needed in their financial statements. So what does that mean for provincial and federal governments? Well, your governments are not municipalities, but you are still consolidating a number of government entities that are facing unprecedented conditions themselves as a result of the impacts of COVID-19. And obviously, the provincial and federal governments are facing those issues as well. And it's really management's responsibility to make an assessment of a public sector entity's ability to continue as a going concern. So when we're looking at going concern, there's some factors on the next slide here which we would take into account. So when you would look at normal liquidity and solvency ratios, but you also would consider if it's a government, will they have the power to levy taxes? So that can help them through some of these situations. If it's an individual entity, do they have multi-year funding agreements that can't be broken in place? What kind of other sources of funding or revenue are available for them? So you're going to consider all these things when you're looking at going concern. But because this is such an unprecedented situation, it's really important to look at various scenarios and appropriately weight those scenarios, including the negative scenarios that may happen, because we really don't know how long this is going to go on for and how great the impact is going to be. So we're not saying that every public sector entity is going to have a going concern problem or is even going to need going concern disclosure in their financial statements. But the big issue is that we should be doing a more robust going concern assessment than we probably have done in the past, and making sure that that is documented appropriately in your audit files. Okay, so if we move on to impairment issues that we might encounter as a result of the impacts of COVID-19, when a public sector entity has not yet adopted Financial Instrument Section PS 3450, it follows Section PS 3030 on accounting for temporary investments. And those are short-term investments that are made to obtain a return on a temporary basis. They're usually capable of reasonably prompt liquidation, so things like treasury bills, investment certificates. And when the market value of those investments has declined below their carrying value, a write-down is needed to market value. So we may see more of that as a result of COVID. Portfolio investments, many governments have these. They're longer-term investments in equity or debt instruments of organizations that don't form part of the government reporting entity itself, and they're accounted for at cost or amortized cost. And due to the impacts of COVID, there may be a loss in the value of the portfolio investment. And that loss in value needs to be recognized when it's considered to be other than temporary. So the handbook goes on to say in sections PS 3040 and 3041 on portfolio investments that a loss in value is really considered to be other than temporary when it's expected to remain for a prolonged period. And the handbook even uses, looking at whether a condition has persisted for more than 3 or 4 years when you're looking at a prolonged period. So you could definitely have impairment earlier than that, but there is some guidance in there on that gives you some sense of what a prolonged period would be considered under PSAS. So we may not see as much of a decline in the recognized in the financial statements for a loss in value of portfolio investments at March 31st year end. But something to consider is if you have a portfolio investment with a fixed maturity amount, a decline wouldn't be considered temporary if it's anticipated that the investment will be disposed of before it matures, or that value is not going to rebound before that maturity date. So you may have a write-down in those types of situations. Another thing I want to point out is for the subsidiaries that you are consolidating that have already adopted the new Financial Instrument Section PS 3050, and have investments in equity instruments and financial assets and financial liabilities that have been measured at fair value, they probably are going to have a significant loss at March 31st, just due to the volatility that has been happening in the markets. So that's something just to keep in mind upon consolidation. So accounts and loans receivable, due to financial difficulties of borrowers, increased valuation allowances are likely going to be needed this year. More write-downs are probably going to be needed. One thing when you have loans receivable is to remember that if collectability of principal and interest is called into question, then we need to stop accruing additional interest revenue at that point as well. Moving on to taxes. So everyone on this call, we know that you are very well versed in accounting for tax revenue, and you have economists and experts that are going to help you in determining the amount you need to record in your financial statements. So we're not going to go into depth on this topic today, but just some things we need to keep in mind in general are, as you know, tax revenue is ultimately an estimate. And the initial measurement is based on management's best estimate of the amount of tax revenue as a result of the original taxable event in accordance with the tax legislation. So at the point of initial measurement, tax revenue isn't actually known with certainty, even though it's based on actual tax assessments, because more information and better information is known over time as a result of events like audits, appeals, court decisions. So as more information becomes available, that estimate changes. And in subsequent periods, we always have to do an assessment on whether or not or how much of that tax receivable that was originally set up is ultimately collectible. So as a result of the financial impacts that your taxpayers are going through from COVID-19, there probably is going to be some uncollectible taxes, or you may need to reassess that valuation allowance related to those taxes. The other thing to keep in mind is that there's just so many variables in place right now, and your normal process for estimating tax revenue has likely been changed significantly because taxes are being deferred. You're not going to have the same amount of information that you typically would have had. As a result, there's more estimation uncertainty and measurement uncertainty at year end, and because of that, you may need additional measurement uncertainty disclosures included in the financial statements surrounding this very large estimate. If we move on to the next slide here, another area to watch for is related to accruals. So a public sector entity can incur a liability as a result of an agreement it enters into, its own legislation for governments, another government's legislation, a constructive obligation, or an equitable obligation. And as a part of responding to this COVID crisis, governments may introduce legislation that results in obligations for itself or other public sector organizations. So for example, passing legislation prior to March 31st, 2020. So the federal government passed the temporary wage subsidy program into law on March 25th, 2020. So there's an obligation at year end related to that. Determining the estimate of the amount is going to be a difficult manner as well, and there is probably going to be more measurement uncertainty disclosure required related to that. Additionally, a public sector entity may incur constructive or equitable obligations when it's created a valid expectation, among others, that it has no realistic alternative but to settle that obligation. So for example, by making an announcement that individuals and entities have then acted upon. So, for example, the federal government announced the Canada Emergency Wage Subsidy, the 75% subsidy on March 25th, but it wasn't actually passed into law until April 11th. So such a promise would need to be evaluated at year end to determine whether or not there's a constructive obligation at year end. So public sector entities really need to make an assessment of whether there's any obligations out there that you may not have typically had, but you may have as a result of COVID at March 31st. So along that same lines, if we move on to talking about government transfers and tax revenues, because of the response to the COVID crisis, various levels of government are providing grants, stimulus packages, tax deferrals, like I mentioned before. And for entities that are providing the relief, so that are really the transferor in that situation, they need to make an assessment of whether or not the transfer is being provided as a government transfer that's accounted for under Section PS 3410, the government transfer section, or as a transfer through the tax system or a tax concession that would actually be accounted for under the tax revenue section, Section PS 3510. And the reason why that matters is there is different criteria in the sections that could impact the timing and the method of recognition of those transfers. If an entity is on the other side and they're the recipient of a government transfer, they may want to set up a receivable at year-end based on announcements that have come up, and they really need to determine whether or not they meet the criteria to set up a receivable and whether the definition of an asset is met. So if we look at the next slide here, this just gives a high-level overview of what you need to consider when you're dealing with government transfers. So if you're a transferor, when the transfer is authorized and all the eligibility criteria are met, that's when you recognize the expense. If you're a recipient, it really depends on whether or not there's eligibility criteria and or stipulations, and whether or not those are met determines the timing of revenue recognition. So there was a lot of new funding announcements and legislation being passed around that March 31st, 2020 date. So it's really critical to know the dates various events occurred to determine whether or not you have a expense to recognize, or if you're on the recipient side, whether or not you have a receivable to recognize. And a lot of analysis is probably going to need to go into that, just based on the amount of funding announcements that have come out, and they keep coming out and they keep changing. So there's going to be a lot of professional judgment that's going to need to be used this year. So if we move on to the next slide and just consider some estimates. So as we all know, there's lots of estimates in financial statements, and some things that we would really want to focus on related to March 31st year ends and the impacts of COVID are anything that is impacted by discount rates, because discount rates are changing right now. So for example, if you have contaminated site liabilities recorded on your books, they're typically measured using the public sector entity's rate of borrowing, and that rate may have changed now, which can impact the amount of the liability that is recorded. If you have employee benefit liabilities, the discount rate may have changed because the government's cost of borrowing has changed, or there's change in plan asset earnings, and that may result in the need for a new actuarial valuation. If you have sick leave liability recorded, or any of your subsidiaries have sick leave liability recorded, we really are going to need to look at the assumptions this year and going forward on whether or not the typical assumptions we consider for sick leave liability are still relevant. I don't think any of us are going to go back into a world where everybody just goes to work whether they're sick or not anymore. That's probably going to change for a while now, and we may see more people drawing down sick leave liability than we historically have in the past. If you are a government that has provided a number of loan guarantees are accounted for as contingent liabilities. So a provision is recorded when it's determined that a loss is likely related to that guarantee. And because of the financial difficulty that borrowers are facing right now, you may be called upon to actually pay out more of those loan guarantees than in the past over the next few years. So we may need increased provisions at year end related to them. If we have event cancellations at year ends for conferences, things like that, we would need to consider if that cancellation is confirming events that already existed at year end and if there's any liabilities related to that. And just in regards to other revenues, so things that aren't under the government transfers or the tax revenue standards, we need to consider the timing and amount of recognition. So a lot of public sector entities have been shut down as a result of the lockdowns that we've been going through. So for example, public sector colleges have had to shut down their campuses, and many of them have moved courses online. And some of them haven't, but most of them have. But even in that situation, if a course is being provided online, are students still going to ask for refunds because they don't think that they've received the same services they would have had they've been listening to a lecture or doing labs in person? So there may be more refunds that need to be offered. There may be deferrals of when revenue is recognized depending on the timing of when services are going to be provided. And that's ultimately going to affect the amount of revenue and the timing of revenue recognition. So as this slide said, when we look at estimates, we usually consider history as a good predictor of the future, and we use history quite a bit in setting estimates and looking at whether or not they're reasonable. But because of the impacts of COVID, the history isn't necessarily a good indicator of the future anymore because we really don't know what's going to happen in the future. I can imagine none of us thought we'd ever be facing the situation that we're in right now, and so it's hard to know what the future is going to look like. So when we're looking at estimates this year, we really need to challenge whether or not the assumptions are reasonable based on the circumstances that we're in, and we need to include additional disclosure when there is a lot of uncertainty as well. So now I'm going to turn it over to Alicia to talk about some audit issues.
Thank you, Saya. As Saya just mentioned, several of the public sector accounting standards require estimates to determine the impact of those estimates on the financial statements of the entity. Saya also highlighted that COVID-19 has created a lot of uncertainty, and this uncertainty is going to be impacting estimates that have previously been made in financial statements and are going to be made for different items in this March 31st, 2020 year end. Historical information may no longer play the same role in assessing the validity of these estimates, and we need to ensure that we are getting a clear understanding of how management is developing the accounting estimates it is making. And we need to determine the degree of uncertainty that exists inherently in those estimates. If there's a significant degree of uncertainty, we then have to ensure additional audit procedures are performed. The slide in front of you, and for your reference, I'm on slide 17, outlines the additional procedures that are required once it's deemed that an audit estimate contains a significant risk of material misstatement. In addition to the issues that are going to arise around the audit of estimates, materiality is also going to have to be considered for these upcoming year ends. Auditors will need to consider how COVID-19 will impact materiality, and during that assessment, users will have to be kept front of mind on where they're interested in the financial statements and what specific items they will care about. So, in addition, we may want to consider the use of specific materiality on specific line items where users are going to be making decisions on those items. Changing business practices and the changing business environment will also affect factors that go into determining the percentage to apply for performance materiality. As a refresher, performance materiality is set to reduce to an appropriately low level the probability that the aggregate of uncorrected and undetected misstatements will exceed materiality for the financial statements as a whole. Another key consideration that's going to have to be made is the impact of unadjusted errors. This impact will have to be considered both on the unadjusted errors that are coming into the year end that's being audited. It is highly probable that materiality will be reduced this coming year, so there is a possibility that prior period adjustments will be required on numbers due to the fact of their decline in materiality. In addition, given how uncertain everything is right now, thought should be given into when we're accumulating errors on this year's schedule of unadjusted differences, whether those errors may materially impact it next year because materiality will likely also be reduced for the 2020 year ends. In addition to materiality, we also need to be considering the impact of risk on when assessing the audit for the 2020 year ends. Risk assessment is likely going to have to be broken down into several segments. For the March 31st, 2020 year end, the vast majority of the year was what I would call a pre-COVID type of year. So the processes and controls that existed at the entity were operating in fashions that we may typically have been used to. And once COVID came into play, some of those processes and controls may have ceased operating or may have changed significantly in the manner in which they operate. So it's up to auditors to understand how management has reacted to COVID to ensure that any additional business risks, inherent risk, or control risks are assessed and addressed in our audit file. In addition to risk, we need to be keeping front of mind professional skepticism. As Armin previously highlighted, the entities subject to audit, as well as their staff and management, have been going through a pretty tough time right now. Everyone is adjusting to new working environments and pressures, increased pressure and pressure that they're not likely used to dealing with. So as part of this, we need to be ensuring that we're getting appropriate audit evidence. Audit teams are likely going to be required to go completely virtual for this year end. As we're dealing with virtual information, we have to ensure that we're getting comfortable with the reliability of the audit evidence that's obtained electronically, as well as we need to ensure that we can do effective inquiry of management. We need to consider the use of video conferencing when dealing with complex or contentious issues to ensure that those we're speaking to, that we're having an active discussion with those we're speaking with, and we can watch and assess body language and ensure that proper conclusions are being reached from those discussions. As well, there may be an increased fraud risk as there are changes to incentives, motivations, and opportunities due to this outbreak. A perceived breakdown in oversight combined with uncertainty over financial stability for individual employees could lead to the rationalization of employees to commit fraud against the organization. As well, many organizations are going to be facing increased pressure to present balanced financial statements, and in a lot of instances, those financial statements are going to be prepared with less hands-on supervision. During these times, it's especially important that auditors are applying professional skepticism throughout all stages of their engagements. Other audit considerations include group audit. The group auditor, as you're all aware, is required to direct, evaluate, and review the work of the component auditor. Under the group audit standard, clear instruction and communication must exist between the group auditor and the component auditor to ensure that the audit requirements are being met. The group auditor has to consider the impact and audit implications of COVID-19 at the group level, and they must ensure that relevant work is performed at the component level. So auditors should also be considering if the work at the audit instructions that have been previously provided to the component auditor are still relevant, or if they need to be supplemented to address issues that now have arisen due to COVID-19. Auditors at the group level are also going to have to consider the impact of travel restrictions. Historically, group auditors have went on site to the offices of component auditors to review working papers to help them assess the impact of the entity at the group level. That on-site access will likely continue to be prohibited for the foreseeable future, and so group auditors are going to have to come up with other ways to gain relevant comfort from the component auditors. Where face-to-face procedures are not applicable, other means such as remote access and/or video conferencing will have to be considered. As the group auditor, you will need to be prepared that some of the component auditors may also not be able to complete their audits due to the physical distancing constraints. There must be clear and effective communication between the group auditor and the component auditors to ensure that the requirements of the group audit standard are met. Other considerations, I'm now on slide 22, that need to be considered for March 31st, 2020 audits are the impacts of COVID-19 when obtaining information about entities under audit through walkthrough, as well as the impact of COVID-19 when relying on assurance obtained through test of controls. As highlighted earlier in the presentation, at the point in time of March 31st, COVID-19 was declared a global pandemic, so many entities were practicing social distancing. Many entities have had staff working remotely from home. Many entities have had to shut down storefronts, physical office locations, and as a result, controls may have ceased operating or may no longer be operating as effectively as they once were. We must also keep in mind that controls are only as good as the information used in the control. For example, if one of the controls being relied on to gain assurance is that some officer of the entity is approving or looking at some sort of exception report, consideration is going to have to go into whether or not that exception report has remained valid. Auditors are going to have to take a step back and make sure they understand the process of controls changed, as well as they're going to need to take a step back and ensure that the ITGCs, or information, technology, and general controls, have not significantly been changed or broken down during the transition to working from home. Some entities may already have had infrastructure in place to allow for remote work from home capability, but many others may have had to establish this capability on the fly. Having to institute remote access within a matter of a couple weeks raises question on whether or not program change controls, logistical access controls, and other ITGC controls have continued to be appropriately applied. As well, as auditors, we're going to have to consider how we can obtain great evidence to ensure that those controls are operating effectively. In addition to the constraints put on tested controls and ITGCs, we will have to also consider substantive analytical procedures. For March 31st, 2020, substantive analytical procedures may no longer be appropriate for audit purposes. Or it's possible that the entity under audit can be audited using SAPs for the first 9 or 11 months of the year pre-COVID, but then for that remaining, the month of March or potentially the month of February, March, those months will have to be tested through other substantive tests, because an auditor can no longer predict the reliability or the relationship between the values and the numbers due to the changes that have resulted from COVID. Although the expected direction of movement in an account for COVID will be easy to understand, it's going to be very difficult to determine how large of a change really could one expect. How could one know if a 10 or a 70% drop in expenditures is reasonable in March without having any historical data to refer back to? Because the changes in the world due to COVID are so unprecedented, there's nothing to compare to, and it will likely be nearly impossible to estimate the impact of these events. As well, auditors will have to consider for entities that have material inventory balances how that inventory count is going to be handled. There may be circumstances where physical inventory counts may be able to be attended to, but there's going to be other situations where a physical inventory count is considered impracticable because the auditor will not be able to attend the client's premise. In response, virtual observation of inventory counts have been considered when there is a situation where a scope limitation is not an option, but the additional time and risk involved with virtually attending an inventory count should be exercised with caution. As well, auditors should be considering options to obtain sufficient appropriate audit evidence over inventory, depending on the circumstances. There may be the ability to delay inventory counts and later on do significant rollback procedures, as well as we may be able to do procedures to roll forward last year's observed inventory balance to this year end of March 31st, 2020. One item that we need to keep into consideration is when we're determining if rollback procedures are an option, none of us have a crystal ball at this point, and we won't be able to determine at what point we would be able to get on site to observe inventory and then roll those numbers back to March 31st. Other items to consider are to take a look at the impact service auditors reports we'll have on the entity under audit. I am now on slide 24. we are expecting that there's going to be significant delays or potential inability to obtain service auditors' reports that were maybe previously obtained in prior years. Auditors are experiencing an inability to be physically present, as you're all aware, at client site, and due to this limitation, it's expected that service auditors' reports will be delayed. In some cases, we can look to entities under audit to see if there's compensating controls to audit sort of around the activities conducted by the service provider. But in some instances, it may be very difficult to audit around the service provider and the report may not be available. So if alternative ways of addressing the area are not available, there's the potential that audit reports will be delayed for entities, or there may be modifications to audit reports that are presented. The majority as well, we're expecting that some entities under audit will have modifications to their audit report. The majority of qualifications related to COVID will likely be scope limitations because the impact of such things will be difficult, if not impossible, to ascertain. As well, the scope limitation will exist due to the inability to assess certain records or perform procedures. We are also expecting entities to have gap departures where specific disclosures are not feasible this year, and we need to consider the issue leading to qualification and take that step back and utilize professional judgment to determine if a disclaimer of opinion is warranted. It is also important to consider whether audit reports should include an emphasis of matter or EOM paragraph. As we get further and further into this pandemic, it's expected that the impact will be more and more prevalent. And due to the prevalence, we're expecting there may be an increased usage of EOMs in the future. Okay, I believe I'm turning it back to Armand at this point, or is it Say? I'm sorry, guys.
Well, that's okay, Alicia. It's me. So now we've kind of talked about the things that we see as the biggest impact for March 31st, 2020 year ends. And now we're going to talk about some other issues that could still impact March 31st, 2020 year ends, but they're likely going to have a bigger impact on future year ends. But they're important to be aware of. So modifications to loan agreements. A lot of this is going to happen subsequent to March 31st, 2020, and there can be modifications on both the lender and the borrower side. So we could have modifications in the form of forgiveness of principal and interest payments, reductions in interest rates, modifications in the payment terms, grace covenants or grace periods for covenant violations. And if you are the lender, you need to look at the guidance in section PS 3050 on accounting for modifications of loan receivables. You also need to watch if there is going to be additional concessionary loans that are going to be provided during this time, as the accounting for those is a little bit different. If you're on the borrower side, then we need to look at how does the modification impact us under the long-term debt section, PS 30, or if you've already adopted the new financial instrument section, we'd look at the guidance on modifications in section PS 3450. Leases are also probably going to be modified, and we may have rent-free periods, deferral of payments, cash payments from lessors to lessees to help compensate tenants for this disruption and help them survive during this period. Unfortunately, the PSAS handbook doesn't actually provide specific guidance on accounting for lease modifications. So we're actually going to need to use a lot of professional judgment in this situation on determining how to account for them best. In terms of employee benefits, we may see a lot of changes in the future. You know, some public sector entities may have downsizing to their workforces, may have early retirement options in order to try to cut some costs. And we need to consider when the timing of termination benefits would need to be recognized as an expense under section PS 3255 on employee benefits. And there's various criteria in that section that tells you when the timing of that recognition occurs. Similarly, because of the impacts of COVID, we could have situations where there's temporary deviations from benefit plans or there's planned curtailments. And as a result, there may need to be updated actuarial valuations as well. An entity may be claiming business interruption insurance, and we need to consider have we met the definition of an asset? Can a receivable actually be recorded at year end related to that? Or are we in the position where we could disclose a contingent asset, but we don't have enough information to actually be able to recognize an asset at year end? Force majeure clauses, these are something that we didn't really see used a lot in the past, but now they're probably going to be used quite frequently. So you may be auditing an entity that is claiming force majeure against someone else, or you may be auditing an entity that force majeure is being claimed upon related to the contracts that they've entered into with others. So determining how to account for those and watching to see if those types of clauses are being utilized is something we're going to need to watch for the next few years. And as we mentioned, as Armin mentioned earlier, more issues are arising daily. This is we're really only in the beginning stages of the financial impacts of this crisis, and we're seeing newer and more issues coming up all the time, and issues that we've never really encountered before. So it's going to be an interesting few years from an accounting perspective, accounting for all the changes that result from this crisis. So we talked a little bit about impairment issues earlier and issues related to impairment that are probably going to impact March 31st, 2020 year ends. So now I want to talk about some additional impairment issues, but these will probably have an impact on March 31, 2021 or later year ends. So in terms of impairment of tangible capital assets, when conditions indicate that a tangible capital asset either no longer contributes to a public sector entity's ability to provide goods and services, or the value of future economic benefits associated with the tangible capital asset is less than its net book value, that's when you need to consider whether a write-down is required. So under PSAS, tangible capital asset is really considered to no longer contribute to an entity's ability to provide goods and services when the entity no longer intends to continue using the asset and doesn't have an alternative use for it. In terms of considering whether there's a decline in future economic benefit, that's really when there's been a change in the extent to which the asset is used, the manner to which it's used, whether it's been removed from service, or there's a decline or a cessation of the need for the services provided by that asset. So under PSAS, these conditions really need to exist for several successive years to see whether this is just a temporary situation or whether it's really expected to be permanent. And PSAS financial statements don't typically like a lot of volatility or things like that. So it's really more of when there's a permanent impairment in these assets, that's when you would write them down. So for most public sector entities, we probably won't see impairment of capital assets in the near term, but it could be something over the longer term as entities change the services that they provide and maybe they no longer have a use for certain assets and there's no alternative use for them, or entities are restructured completely and maybe some of those assets no longer have the value that they had before. So if we move on now to talk about business partnerships and government business enterprises, as a result of the impacts of COVID-19, there's a number of things we could see related to these types of entities. So there could be impairment of debt issued on behalf of government business enterprises. So when a public sector entity issues debt on behalf of its GBE, it recognizes that debt net of the related receivable from the GBE as long as certain conditions are met. And because of the impacts of COVID, we need to assess whether or not those conditions are still met so that we can still net that debt against the receivable. And if it's not met, then presentation would need to change. We need to also assess whether or not the receivable is impaired as well. We may also see reductions in the carrying value of the investments in government business enterprises and business partnerships because of operating losses those entities incur or impairment that occurs in those entities. And impairment is significantly more likely to occur under IFRS than it is under PSAS, and those types of entities are required to follow IFRS under the public sector handbook. So as a result of that, when you're doing your modified equity pickup, you could be picking up more significant losses. And some of those losses may cause your carrying value to actually end up in a negative position. And under PSAS, you can end up in a position where the carrying value of that investment is negative. There could be impairment of the carrying value of an investment in a GBE or a business partnership. So when that investment has ended up negative or there's other conditions suggesting that there's an impairment, really when there's impairment, it really calls into question whether or not that underlying entity, the GBE or the business partnership, actually continues to meet the criteria to be classified as such an entity. And it's really that criteria in the definition of those types of entities that requires them to be able to maintain their operations and pay their liabilities based on revenues that they are generating themselves and that aren't coming from their parent government. So we're probably going to see more GBEs and business partnerships that were, particularly those that were kind of on the edge already financially, no longer meeting the classification criteria. And when that happens, then we need to reassess what type of entity those would be considered to be. So for example, for a GBE, if it no longer met the definition to be classified as that, it would probably be classified as an other government organization. And this calls into this results in some other accounting implications because other government organizations have to be consolidated. So the financial statements of the GBE would need to be converted into PSAS in order to do that qualification. So there's definitely a lot more accounting and audit implications as a result of those types of things if they occur. And a similar situation would occur for business partnerships that no longer meet the criteria to be classified as such, and would be a non-business partnership that would need to be proportionally consolidated. So some additional things just to keep in mind related to those types of entities, and we probably won't see those right now, but those issues we may be seeing more in the future. So now I'm going to turn it over to Armand to take us through a couple slides to wrap up.
Okay, thanks, Faye and Alicia. Just a couple things. We have some questions came in. Great questions came in. And just so you're aware, if I say something's a great question, that is code for I probably don't know the answer. But really good questions have come in. But just before we get to those, just a couple of resources here. Check out our content on PSAS in general, and then also our COVID-19 hub for all your questions related to COVID-19 and the implications of it. But getting to questions, I'm going to take the first one, Say and Alicia, because I love this question and I get to pretend that I'm an actuary in answering it. The question is about pension plans and the change in discount rate, and the question is, do we just look at this change in rates right now? And as we all know, the Bank of Canada made 3 rate changes, I believe, in the month of March. I think the rate we're now at 0.75 is the rate it's sitting at around. And the question is, when we look at a pension obligation, that's an obligation that's going to be paid out over 30 to 40 years. So do you take that change in rates into consideration? And the answer is not necessarily, right? Because at the end of the day, when you're looking at a pension obligation and you're basing that pension obligation, let's say on the borrowing rate of the government, if that's the policy that's being used, you're going to look at what is the rate related to that payment stream. So you're going to look at what's going to happen to rates over the entire yield curve. And although rates are dropping at the short end of the curve, I don't believe they're dropping as much at the long end of the curve. And as a result, that if they're not dropping at the long end of the curve, that is likely going to have very little impact on the actuarial liabilities. But ultimately, this is where the expertise of an actuary comes into play, and someone who can talk about a yield curve much more intelligently than I can. But that is a great question, and funnily enough, when we did our internal session at BDO, we had one of our partners ask the exact same question. So that's why I really like that question. And the next question, I think this is also a great question, and it's one I've been thinking of, and actually before Alicia and Say and I were talking about this session, thinking about some questions that might come up. This one is somewhat in line with it, and it's one related to the relevancy of the financial statements as a whole, and even the presentation of the budget figures, and comparing the planned to actual, which is actually a requirement in the public sector standards. And it's an interesting question. Why I think it's a really interesting question, because I don't believe any of the senior levels of government have actually tabled a budget this year for the fiscal 2021 yet. So also creates some interest in, if there's no budget tabled, what do you actually compare to? So I don't know. Maybe say, do you have any thoughts on this one?
Well, I think, it's probably unlikely that we're going to get to the end of 2021 and a budget hasn't been tabled. But I do think, just in terms of relevancy of the financial statements as a whole, there is a lot changing right now, and the financial statements definitely are not as stable as we usually like them to be. I know, being accountants, we like stability and historical results. But I think that the financial statements are actually really important right now. Taxpayers and users of the financial statements do want to know what kind of shape their governments are in. And I think we're going to see a lot more disclosure needed in the financial statements to really explain what's going on. And budgets may not be comparable to actuals, because it's going to be very difficult to budget even for the current 2020 year. What we budgeted back at the beginning of the year is going to look extremely different from what's happened at March 31st, 2020. But I think explaining to users what's happened and putting in more disclosure to really make those financial statements useful and tell the story of what has occurred is going to be really, really important.
Okay, thanks, Saya. Alicia, I have a question for you, and I think this is a question that we've actually seen in our client base with some of the entities, some of our government clients, have, and being a GBE. And the question is, what time period do you look at when you're looking at the criteria for determining if something's a GBE? Just, if it loses money for 1 year, it goes negative for 1 year, is that is that a trigger to move it to an OGO, or is it a longer period you would consider?
I would say a one-time blimp. So if the GBE had a loss this year, would not be enough to force it to be reclassified to an OGO. I think instead, it's going to be more of a understanding the future plans of the organization, and based on its planned results, can it continue to be a GBE into the foreseeable future? So again, it's not a decision that needs to be made based on 1 year's results. It's really the longer-term plan and the validity of that organization to be able to generate income and stand on its own 2 feet.
Okay, thank you. There's also a question in here about going concern, and what I would say. The question is, when we look at the senior and provincial levels of government, and they're created through the Constitution, what would we look at from a going concern standpoint there? I think Saya, and I'll turn this over to you in a second. I think we don't anticipate the senior levels of government having a going concern issue because of that reason, and their ability to tax and ability, all the things that they can do. But I think, Saya, you were more concerned when you raised that point about maybe the components, the OGOs, the GMPOs below, and what are some of the things you would be looking at in that scenario?
Yeah, exactly. So I think it's more of those individual entities that we need to look at whether there's any going concern issues for them. I don't think the government, the provincial and federal levels of government themselves are going to have a going concern issue, but you may have some government not-for-profits that maybe they do have some going concern some issues there, and we really need to look at, do they have funding agreements in place? Are there any restructuring plans to combine maybe government not-for-profits to cut some costs but make them still viable? Do we have other projections for changing the types of services that are going to be provided that makes them still relevant? Are there other things like that? Those are all things that I think we'd need to consider and look at when we're doing a going concern assessment. And it might be that some of those entities are still completely fine, but it's just that we need to do an assessment this year, and we don't typically think about doing going concern assessments as much in the public sector, I think, as we do in the private sector and the public company space. So it's just something that we need to keep on our radar.
Okay. I do have a couple additional questions that came in through emails to me. I know we're a little over time, and we've lost some people, but if people are willing to stay on for 5 more minutes, we'll get to those questions. But I just want to remind people, before you, in case you do have to drop off right at 2, if you called in and did not use the WebEx platform, you have my email address. Email me that you did attend, because we're then accumulating that, and especially for the federal OAG people, we're providing a list of attendees to your HR people, so you can get credit in your learning management system. But for those of you who can stay for a couple more minutes, I do have a couple of really good questions, so I'd like to stay on if that's okay. The first one that I have, and Alicia, this is about virtual inventory counts, and I'm just making my way through it here, but it is a good question. Is, aside from the virtual count at a later date and rolling back or rolling forward the prior year count, are there any other alternative procedures over existence of inventory that can be done, or is it really going to be a materiality call here?
Unfortunately, I think in a lot of instances, it's going to be a materiality call. That being said, I think it's going to highly depend on what inventory is and whether it's a whole bunch of little things, or if inventory is comprised of a few things that are material. There may be ways to look at the consumption of those goods afterwards, but that is going to be very difficult if there's lots of little things.
I guess the hope is it's not material in many cases.
Yeah.
That's not the greatest answer, but that's what we're dealing with. I think, unfortunately, right now. The next question I think is for you as well, Alicia. It's about analytical procedures. You talked about analytical procedures maybe not being possible for 2020, and I believe that was focused mainly on if you're performing analytical procedures related to stuff that happened in March. But the rest of the year is fine, correct?
Yeah, so I think the key takeaway, whether it's analytical procedures or talks, you almost need to have a timeline in your head of this is how things worked pre-COVID, this is how things worked during COVID, and further down the road, this is how things worked after COVID, and potentially you'll have to be designing your audit to audit those segments separately.
Yeah, I think it's going to be really the whole idea of analytical procedures, whether we're talking about public sector entities or any entities, will be extremely difficult as we look at the periods beyond March 31st.
Because it's going to be really hard to set an expectation, because we know that they've done layoffs, or we know that everyone is working in different environments, so costs may be down, but how do you determine if being down 30% is reasonable or being down 80% is reasonable?
A lot of challenges, and unfortunately they don't go away after March 31st. They maybe get even more difficult. But no, great questions. Thank you, everybody. And thank you again, Alicia and Saya, for your presentations. And thank you to everybody for taking the time to join us today. You will, I believe everybody who registered will get a follow-up email with a link to the recording. If any of your colleagues did not have an opportunity to attend today and you'd like to share that link with them, feel free to do so. And with that, thanks and have a great day, everyone.